How to understand the stock market. Did you know that if you had invested just $1,000 in Amazon when it went public in 1997, it would be worth over $1.5 million today? Or that by keeping your money in a traditional savings account, you're actually losing money thanks to inflation rates that outpace typical bank interest rates? The stock market has historically offered an average annual return of 10%, while savings accounts hover around a measly 0.3%. If you're only saving, you're leaving your money on the table. Keep watching Unschooled Genius for the next 5 minutes or so to find answers to your common questions about investing in the stock market. Disclaimer: always consult a professional before making investment decisions. Investing in the stock market can feel intimidating, especially if you're just starting out. But it doesn't have to be. With some basic knowledge and a bit of planning, you can build your financial future. Let's break it down step by step so you can confidently get started on your investment journey. 1. What is the stock market and how does it work? The stock market is a place where investors buy and sell shares of publicly traded companies. When you buy a stock, you're purchasing a small piece of ownership in a company. If that company does well, the value of your shares can go up and you might make a profit. On the other hand, if the company struggles, your shares could lose value. Think of it like a farmer's market, but for companies. Investors come together to buy and sell slices of companies in hopes of making a profit. The market operates on supply and demand. When more people want to buy a stock, its price goes up. When more people want to sell, the price goes down. 2. Why should I invest in the stock market instead of just saving money? Saving money in a bank account is important for emergencies, but it typically offers very low interest rates. The average savings account yields about 0.30% annually, not even keep up with inflation. On the other hand, historically, the stock market has averaged a return of about 7% to 10% per year over the long term. That money has the potential to grow much faster through investments. Imagine if you put $1,000 in a savings account versus investing it. In a bank, it might grow to over $1,000 after 10 years. But with the stock market's average return, it could grow to $2,000 or more. 3. How much money do I need to start investing? The good news is, you don't need a fortune to start investing. Some brokerage platforms allow you to start with as little as $1. It's okay to start small. Many people begin by investing just $50 or $100 a month. The key is to start early and be consistent. 4. What are the different types of investments available to beginners? When you're new to investing, it's helpful to know your options. Stocks. These are individual shares of a company. They can be high risk, but also high reward. ETFs, exchange-traded funds. These are like baskets of stocks that you can buy in one go. They are great for beginners because they spread risk by diversifying across multiple companies. Mutual funds. These are managed by professionals and invest in a variety of assets, like stocks and bonds. They usually have higher fees but can be a safer option for long-term growth. 5. How do I open a brokerage account, and which platform is best for beginners? To buy stocks, you need a brokerage account. Opening one is as simple as opening a bank account. Look for platforms that are beginner-friendly, such as Robinhood, Fidelity, or Charles Schwab. These platforms often have no fees for trades and offer easy-to-use mobile apps. You'll need to provide some personal information, such as your social security number and a bank account for funding. 6. What factors should I consider when choosing my first stocks or funds? When selecting investments, start with what you know. For example, if you believe in the future of technology, consider investing in tech companies. Pay attention to dividends, as some companies pay you a portion of their profits regularly. Look for blue-chip stocks, which are established, financially stable companies like those in the S&P 500. It's wise to research a company's financials, recent news, and industry trends before buying shares. Tools like Yahoo Finance and Morningstar can help you dig deeper. 7. What is dollar cost averaging and how can it help reduce risk? Dollar cost averaging, DCA, is a strategy where you invest a fixed amount regularly, regardless of market conditions. This means you buy more shares when prices are low and fewer when they're high, reducing the impact of market volatility. For instance, investing $100 each month in an ETF can help you stay steady during market ups and downs. 8. How do I track the performance of my investments over time? It's important to check on your investments periodically, but don't obsess over daily fluctuations. Most brokerage platforms have built-in tracking tools to monitor your portfolio. You can also use apps like Personal Capital or Mint to keep an eye on your overall financial health. 9. What should I do if the stock market crashes or becomes highly volatile? Stock market downturns can be scary, but they are a normal part of investing. The key is to stay calm and avoid making emotional decisions. Selling your investments out of panic often locks in your losses. Remember, historically, the market has always bounced back after crashes. In fact, market downturns can be great buying opportunities if you have cash set aside. 10. How can I continue learning and improving my investing skills? Investing is a journey, and continuous learning is key. Consider reading books like The Intelligent Investor by Benjamin Graham or A Random Walk Down Wall Street by Burton G. Malkiel. Podcasts and YouTube channels such as Bigger Pockets Money or The Motley Fool offer great insights as well. In addition, joining investing communities online, like forums on Reddit's investing or Facebook groups, can help you learn from others' experiences. Investing in the stock market is one of the most powerful ways to grow your wealth over time. Yes, it can be daunting at first, but starting small and being consistent can lead to great rewards. Remember, the best time to start investing was yesterday, and the second best time is today. So take that first step. Your future self will thank you. Share your investing experiences in the comments below and include any tips I haven't included. Don't forget to like and subscribe so you don't miss out on future videos. And I will see you soon for more Unschooled Genius.